Greetings, everybody. It is 1 o'clock, and we're going to dive right into this quarter's capital markets and economic perspectives. And I'm Ivan Alon, the founder and chief investment officer at Awame. And so every quarter, what we try to do is share with you our research, insights, data that we find interesting, and certainly that informs our portfolio strategies for our clients. And there's quite a bit to go through. There's a lot happening in the world today. And so we can dive right in. Thank you. And I know folks are joining us as I'm proceeding. Here is some disclosures, so please take a moment, or if you look at this through recording, you can read through these disclosures. Essentially, past performance does not guarantee future results, and other relevant information. Along the way, throughout any quarter, certainly I encourage you to follow us on YouTube at our YouTube channel, which is Awame_CIO. And also you can follow us on our LinkedIn page at Awame, my Twitter account, Ivan_M_Elon, and also our Instagram account, Align_Wealth. And we're certainly posting all throughout the quarter various updates, my monthly article in Forbes, YouTube videos that usually riff on the theme of what the Forbes article is on, as well as our monthly podcast available on all podcast platforms, including Apple Podcasts. If you have any questions along the way, please feel free to ask them in the Q&A applet below and through your portal, and happy to answer those as they pop up. And we do have 4 core strategies, total portfolio solutions. You can learn more about those on our website at alignwealth.com under the resources tab, and then ACGM Portfolio Suite. You'll see the references to 4 fact sheets there. And if you'd like to request an updated fact sheet, please feel free to email us at info@alignwealthllc.com. And our performance is independently verified annually, and we are seeking to generate alpha, which means positive risk-adjusted returns relative to the benchmark. And happy to share that performance history with you. Along the way in this presentation, you'll see a box on different slides, and that box represents the rationale or positioning that we currently have within our portfolios. So it's just about connecting you to exactly what are we doing inside these portfolios and why is this important. So the first thing we're going to dive into is talking about stocks, everybody's favorite topic. Everybody loves talking about the stock market. Very exciting, very interesting things going on. So one of the things to draw attention to is that equity hedging, specifically within the S&P 500 constituents, so individual stocks within the S&P 500, there continues to be a tremendous amount of short positions. So very basically, if you're long a stock, it means that you hold the stock and you believe the stock is going to go up in price because you want to sell it higher at a later date. If you're short the stock, it means that you believe that the stock price is going to be lower in the future. So somewhere around the early part of 2023, and this was really right around the time of the bank failures with Silicon Valley Bank and a couple of other regional banks, we noticed this huge uptick in short positions on S&P 500 companies. And that has remained very elevated, sometimes getting even more elevated. But notice it is way, way, way above this 10-year average. And that's certainly, or rather the past five years or so, way above the average, almost 300% higher than history, recent history. So including the last recession. So this is very notable to have this much money that is positioned for a decline in the S&P 500. It certainly has us concerned. And so as a result, we are underweight significantly to U.S. market cap leaders. And more specifically, we have 0% exposure to the S&P 500 index as a market cap weighted index. So that's a very important distinction. We do have S&P 500 exposure, but we do it through an equal weight exposure so that we have the exposure to all 500 companies, but we don't want those few leaders of the S&P 500, those 5-7 different companies that I'm going to talk about in a second, that represent 30% of the S&P 500. We don't want that concentration risk. Our feeling is that quite a bit of those leaders are vulnerable should any whiff of recession really reach the broader market participants. So this is very concerning, something certainly to be very aware of, and also monitoring when does this abate? When do we see these short positions collapse and come back down? Keep in mind that managers, investors, when they have short positions, it costs them money to maintain this type of positioning because they're borrowing shares and they have to pay interest on those shares that they're borrowing. So this is something very important to keep tabs on. Certainly is a bearish indicator from our standpoint. Last year, all you kept hearing about was the Magnificent Seven, how amazing they are, how magnificent they are. Well, they're looking less and less magnificent. And here on this chart, you'll see Apple, Microsoft, Tesla compared to just the S&P 500, S&P 400, and 600, which are small and mid-cap indices. And you can see that, Apple through the end of April has been down almost 12%, Tesla down almost 26%. Microsoft up only about 3.5% compared to the S&P, which is up about 6%. S&P 400 up about 3%, and the S&P 600 is down about 4%. And again, that's the small cap index. So not looking so great. After all that hoopla last year, they've definitely had a bit of a fall from grace, some of these constituents of the Magnificent Seven. Obviously, tomorrow is May 22nd, on Wednesday. NVIDIA publishes their earnings results. So the market's very excited about what that's going to look like. And of course, if that is anything but glorious, it could send stocks certainly lower. And so again, we continue to be underweight U.S. market cap leaders because these few companies represent such a huge percentage of the overall market. And so we just don't feel comfortable holding these positions or having these exposures for our clients' assets at this point in time, given the overall vulnerability and their very stretched valuations relative to other parts of the marketplace, which certainly do not display that. There was a research highlight published in April of this year. It says 22, but it's actually 2024. Information tech represents 5% of GDP, but actually represents 30% of the US stock market. So this is an interesting slide because it essentially is talking about the Buffett indicator or the Buffett ratio. And if you're not familiar with it, it's a very simple calculation that Warren Buffett likes to reference all the time, which is taking the Wilshire 5000 market cap, which is the total market capitalization of the whole U.S. stock market, and dividing it by the U.S. size of the economy, U.S. GDP. And you can see what those values are here in this above area. But below is actually the formula and the calculation, dividing the Wilshire 5000 divided by U.S. GDP. And you see that the 10-year average basically is at 144%. And you can see for quite a while of that, especially prior to the recession, last one that we had, it was even well below that. And right now we're sitting at around 187. So from Buffett's standpoint, this is a market that is certainly highly overvalued. And remember that stock prices, they're very fundamental, in the most fundamental way, is simply the stock price is a present value calculation of all future earnings. And so uh, having a valuation at 187% of the economy is something that is notable. It's certainly not at the peak like we saw in 22, and there was a bit of a downdraft more to the average, but since then it's come way back up. But this long-term average, there's going to be variance around it, but right now we're well above that. So the idea that there may be some downside exposure is quite relevant. And M&A deals are up 27% despite higher rates. And what's most interesting about this is that the M&A activity and dollar volume actually peaked during a period where the average federal funds rate was in the 5 to 6% range. And this was before we had the zero interest rate era that we most recently saw in the past decade. And so this is very positive for small and mid-cap stocks, because these are the types of companies that are actually engaging in M&A activity quite frequently, either through acquisition or mergers, or being targets. And that tends to keep prices more stable, all things being equal, or stable to actually going higher. So this is one of the things that we have going on in our portfolios, where there is an overweight to U.S. as well as foreign small and mid-cap stocks. M&A plays a very important role in that decision making. Let's switch to bonds. So here's a fundamental way of looking at the bond markets and also the stock market. And to make an equivalency out of stocks and bonds, you actually can take the price earnings ratio and flip it on its head. And that creates earnings over price. And that's called the earnings yield. And so what you see here in the orange line is the earnings yield going all the way back to 1990, and fast forwarding through the beginning of May. And generally speaking, and then comparing that to the 10-year US Treasury. So if the 10-year US Treasury is paying you more money, is paying an investor or a capital allocator more yield relative to the yield that you can get from a stock, from their earnings, that's indicative of strength in the fixed income markets, just in terms of risk-adjusted return. And certainly looking back throughout time, in periods where you've had the earnings yield be lower than the 10-year Treasury, that usually didn't work out so well for stocks. So think about the 2000s, after the dot-com crash all the way through 2010. That was a very difficult time for equities, where it's actually popularly referred to as the lost decade. And throughout that period of time, the majority of that time, the 10-year Treasury was actually higher than the earnings yield. And then, of course, there was a big spike up in the earnings yield. So stocks looked like a fantastic place to be from 2010 all the way really through this last recession, and have continued to kind of maintain this until recently, where rates have now been hiked up significantly, and now giving stocks really a run for their money. And so this differential is notable and important. And so we're certainly favoring fixed income securities overall. It's one of the reasons why in our total portfolios, we are underweight equities in favor of adding more fixed income, because we can get really great rates of return with very little risk. And so we would prefer that. And then furthermore, there should be opportunities in the bond markets as we start to perceive more risk showing up in the capital markets, which we're not there yet. Speaking of which, right now, we're seeing essentially spreads, option-adjusted spreads on various types of corporate debt to be very, very low. And so as an example, in the orange, right now, the spread is around 114 basis points, 1.14%. So this means that basically a triple B bond, which is the lowest rated investment grade bond on the ladder that you could buy in the marketplace, that bond is basically paying 114 basis points more in yield relative to a risk-free bond like a US Treasury of equivalent maturity. That's very low. The long-term average going all the way back to 1996 is 1.95. So 1.95 versus 1.45. So this is about an 80 basis point differential. So the long-term average is important because this is the normal amount of risk of default or bankruptcy that normally the marketplace would be concerned about. And right now we're well below that. But even more striking is when you start getting into the junk bond category. Right now it's around 1.84 or 184 basis points. The long-term average for double B junk bonds is 3.5% or 353 basis points. This is huge. This is a big differential. It certainly is saying to us that the marketplace does not perceive that there are any risks associated with companies that have lower credit ratings. We're not sure how the marketplace is coming to that conclusion, considering that interest rates are so much higher than they've been over the past decade. And so how are companies that have already had issues in the past not going to have any issues in addressing these much higher interest rates? So this is of great concern. And something that we also see fantastic opportunity, because when the market does perceive this as a mistake and that spreads should be much higher and should be much wider, that's an opportunity for us to then buy into these high yield segments of the market. We're certainly not near that right now, and as a result, sitting more in cash and ultra short term high grade bonds. And that's where we want to be comfortably until we see these spreads widen where risk is really perceived properly. And so just to reiterate that, we're not being compensated to take on credit risk or duration risk. So owning long bonds doesn't pay you anything great, because we're in an inverted yield curve, which I'll talk about a little bit in a minute. So staying on the short end of the yield curve and have a preference for investment grade, A, double A, really limit the triple B exposure. And that's what we're doing right now in our portfolios as a result of this, what we think is a real characterization of the risk in the marketplace. Let's talk about real estate. Real estate's obviously a huge, important part of the marketplace. And here in Southern California, clients in Florida, we've seen tremendous increases in prices over the past few years. So this is here's some interesting things that are going on in the housing market. For one, we're seeing a big uptick in delinquency rates on multifamily housing. So that's an important thing. Anytime you see increases in delinquency, it means there's something going on in the marketplace where people took on debt that now they're having some trouble keeping up with. Looking at it from another way, this is from Apollo, one of the largest alternative managers in the world, also noticing that delinquency at U.S. banks is increasing when it comes to their commercial real estate loans versus their total loan value outstanding. So these are trends. These are things that are underway and really developing quite rapidly. Looked at another way, looking at 90-day plus delinquencies from just basic FHA mortgages, they're way up. They're back to coming out of the great financial crisis level, and the reason that's being given is unemployment. So which is kind of amazing, because anytime you turn on the news, it doesn't seem like the unemployment rate is at some huge number. Well, this unemployment is actually connected to another theme of underemployment and systemic and functional unemployment, which I'll touch upon in just a minute. But this is a very rapidly increasing delinquency rate, and something that certainly is going to have concern and impact on the real estate market. Of course, it also spells opportunity for those who are sitting on cash who would like to enter the real estate market, but pricing certainly hasn't been adjusted yet fully to incorporate all of these defaults or bankruptcies that are essentially in the pipeline. Economic data. And I have 10 minutes left, and we're going to hit our target and get through all of this. So the true rate of unemployment, this is a very interesting concept that is an important one, and economists talk a lot about what is the real rate of unemployment. And so the headline unemployment maybe looks like 3.8%. But when you factor in all of those who are in the marketplace with the gig economy, part-time jobs, or have they're an Uber driver and a Postmate driver, and or they've cobbled together a couple of different jobs in order to make ends meet. This is what is termed as functional unemployment, and this has been trending upward. And so the true rate of unemployment, when looked at through this lens of functional unemployment, it's around 24.2% of the workforce. This is big. This is a big number. And it's a number that you never hear about in the media. Nobody talks about, and nobody's focusing on this. But it's absolutely something to be aware of, certainly when you're managing money, and certainly when you're looking at capital allocations and trying to assess forward-looking risk on a forward-looking basis. Something to keep in mind. And to even get a little bit more precise on this employment figure, essentially full-time employment is really hitting lows that are really common during recessions, going all the way back to the 1970s, as you can see by this current level of where we're at. So we've lost quite a bit of full-time employment here in the United States for the past, over the past year, 2 years. And it seems to be accelerating a bit. So this is certainly of great concern. And another element, because everyone's been talking about how strong the economy seems to be, and everything's okay, and everything's going to be fine. Well, it's probably due to this, which is that 38%, just call it 40%, of total consumer spending in the United States is 40% of that is done by the top income quintile. So and of course, if you divvy up this quintile even more and just look at the top 5%, more than half of this consumption is happening just within the top 5%. So this is a very, very concentrated consumer spending that's occurring. And it's held up by a very small, essentially, segment of the US population. So it's been masking a lot of pain in the economy. And that's something to certainly be aware of. You'd like to see more spread out of spending across different segments of income in the US economy, but that is really not the case at this point in time. And here's looking at and really kind of continuing on this idea of the Buffett ratio or Buffett indicator, looking at the size of one market relative to GDP. This is looking at owner's equity in household real estate relative to GDP, and we can see the long-term average going all the way back. This is a decade worth. Long-term average is 0.9 is the average, or 92%. Right now we're at 114%. Which is the value of real estate of equity in household real estate relative to GDP. And a lot of that has been driven during this period of time where we had very, very, very low rates. The long-term average over the past decade has been 4.34% in mortgages, but boy, mortgages got as low as 2.5%, 2.4%, really, really low mortgages. And so tons of investors came into the marketplace during this period of time, driving up prices. And so all this equity that's been built up has really been on the backs of an institutionally driven investor buying marketplace. And that's just created this incredible growth in the prices of housing. And so obviously it's made it difficult for people to afford housing. But what we've seen now is that the amount of folks who are these investors who came into flooded the market with buying have now really exited the market, and they're not buying anymore. So this is a major dynamic shift. And with a ratio right now 23% higher than the 10-year average, there's certainly room for reversion to the mean, to the long-term average. So the idea of price decline in housing is certainly substantiated with these changing dynamics that we see in the real estate market, residential as well as commercial. Certainly commercial has a different challenge underway as well. Annual interest payments of the U.S. Treasury, of the government on Treasury payments of their bonds that they've issued. It's surpassed $1 trillion. This is the first time in history it's done that. You can see going all the way back to 1990. It would hover around a couple $100 billion a year for a long time, and trending upward, a bit, but then a huge spike up in the recent couple of years. And if nothing happens with rates, we're going to see close to $2 trillion a year in interest payments. This is a big, big deal. And so obviously interest rates staying higher for longer impacts the government as well. However, that's the only way that we're going to be able to tamp down inflation meaningfully. And meanwhile, we're seeing inflation remain a bit high and ticking upwards while the economy is actually slowing down. This has people talking about stagflation, which is certainly a real risk of playing out. And this is looking at what we have seen, which is a positive trend of the Federal Reserve balance sheet declining almost a couple of $1 trillion in the past couple of years. And now the Fed has gotten less gregarious in reducing this. And at the same time, it takes time for a changing monetary policy to really impact the economy. And so this is a slow-moving item. And at the same time, the Fed is quite convinced that we are going to see the impact of this monetary policy shift to more restrictive monetary policy show up in the economy. And that will be the impetus for when they start lowering rates. But we haven't gotten there yet. And most likely they'll start lowering rates after this, perhaps some big market events that drive equity prices much lower very rapidly, and then there's more panic, and then that gives the Fed some confidence to reduce the short-term rates. Meanwhile, we've got about $9 trillion of government debt that are going to be maturing over the next 12 months, and about almost $3 trillion of that is debt that is below 3% in yield. So they're going to be refinancing at much, much higher rates, which is why we saw that chart just a couple of slides ago talking about the big increase in interest payments from the government. And it's the services that have continued to create this very powerful, strong, lingering inflationary pressure. So we have seen it lighten up a bit in goods, in energy, in food. Services remains by far and away where we're seeing a lot of pressure in inflation. And services industry, 80% of our economy is services based. Very important and almost last slide that we're going to look at is looking at the cumulative CPI growth over the past just few years, and the past 3 years, and it's 22% cumulative growth of the price of things in our economy. Meanwhile, household personal disposable income on a real basis after inflation is negative. So So this is this is very newsworthy, and we should be really focusing on items like this. This is why we're seeing record credit card delinquencies, car loan delinquencies, FHA delinquencies. People just have less money available to spend on things, and it's readily apparent in the data. And then lastly, just looking at this inverted yield curve, which is just a nasty thing that's been prolonged for so long, and it's so far below the long-term averages, where usually 5-year treasuries versus 3-month treasuries are around 100 basis points difference from one another. Right now, it's inverted almost 100 basis points. It's 74 basis points. And the 10-year treasury versus the 2-year rate, which is very commonly looked at, is about 35 basis points inverted instead of normal upward sloping of 100 basis points, where 10-year treasuries would be about 104 basis points higher than 2-year treasuries. We have a big mean reversion that we're looking forward to seeing here to create a healthier backdrop for the U.S. economy. And with that, I will end right on time. Well, maybe 1 minute over. If you have any questions, please do ask. And it looks like there's one question. All things considered, should I think investing in commodities as gold or copper? We have thought about adding gold into the portfolio. And we have not at this point, mostly because gold is an inert metal. And so as an inert metal, it doesn't have a management team that's looking to create solutions or change capital structure or navigate the markets. It's just based on demand. And there certainly is some indication that gold can be a good investment. And generally, we like it when people buy it physically and keep it in their safes. But as a portfolio allocation, it can be very limiting because it's so timing based and it's so speculative in terms of its pricing. So we're hesitant to add it into the portfolios themselves, but we do see that gold can be a good and certainly element to have in your broader net worth and something to be keeping in the safe. And with that, thank you so much for joining me on this month. If you have any other questions, please don't hesitate anytime to email us at info@alignwealthllc.com. And we're always happy and ready to answer your questions, and look forward to speaking with you again soon next quarter with our presentation. Take care.